Hello, thank you, Zach and Nate, for doing this. I love this event. I was here last year, and what I really like about it is it enables me to interact with investors that have a different strategy than I do. I really don't do a lot of day trading, but I'm always appreciative of meeting other investors that have strategies that can complement what I'm doing. And cross-pollination ideas is always a good thing. And I do a little day trading because of coming here last year, so to help my strategies and to help me with my returns. So appreciate that. Thanks, Nate. Thanks, Zach, for having me come here today and be able to speak today. So I'm a bullish investor at heart. And going to the short side, whoops, is that working? Going to the short side isn't really something I was very comfortable with for most of my career. I've been investing almost for like 30 years. But I've used red flags usually to just help me call out my long thesis, to know what I'm investing in, and maybe a little portfolio protection, I call it. But then along came the China fraud in the 2010 area to 2014, and seeing authors like Sam and Citron, Andrew Left, start exposing these China frauds, really started kind of adding an element of how I would look at red flags as part of my investment strategy to maybe start actually shorting stocks. And that's what Geo Investing, company I founded, we did a lot of that during the China times. But so it's good to have in the back pocket. I'm glad I do short, and I'm glad I do use red flags to help me find an opportunity. But shorting fraud shorting has changed a little bit over time. And how, during that time was a great time. You could find red flags and actually find fraud. And the regulators cared, investors cared. There was a little fear in the market, so you could really catalyze an idea by investing and writing even about some of these stocks and these red flags. Things have changed a little bit, in my opinion, since then. That was a very special time for short sellers. And if you were a newbie and you got involved then, you thought this is like a piece of cake, it's fraud, boom, done. But I think the reality is that real short selling, real short sellers, the ones who've been around for decades and for years, don't only look at fraud. They have to look at, this is their career, so they need to look at other things besides just fraud, like valuation, just risk that can maybe not end a company, but can definitely make the company weaker, put in a weaker competitive advantage. So that's how to become a better short seller. I think we need to get involved, with that process a little more and understand that more. So, that's the better you are understanding red flags, and knowing what's boilerplate and what's real, what's going to come true, the better your strategy for short selling should become. Because you want to catalyze the idea sometimes as soon as possible, because you don't want to be exposed to the expense of being short. Just time risk in general, of being exposed to a short. And right now more than ever, it's really important because you have to have conviction too, because you may be stuck in a short for a long time because regulators aren't taking action. The markets, just keeps going up. So you may have, in order to stay short, you need to build confidence in your short and understand, okay, if I'm wrong in terms of my timing, am I willing to hold, and do I still believe in the thesis that I have here? So I like to keep things simple when I look at things, because I'm never going to be as good as some of the, some people who are just wired to short. So I like to keep it simple, and I find things that other investors will understand too, because in the end you want the market to understand the thesis and also find it, because that catalyzes the investment eventually. And the more complicated it is, maybe the harder it is for an investor to understand and the market to understand. It maybe makes it harder for the investment to become catalyzed. So, and another thing I want to point out when I go through these, these 4 red flags, this checklist, like some of the ones I go through, I don't only look at it from the opportunity to go and short a company. I also look in terms of, well, which one of these red flags are being over-exaggerated, maybe to go long eventually. Look for those inflection points too. So as I go through each one, I'll talk about how I use that. So, keeping it simple, so the first thing I like to look at, one of the big things I love is margins, because it's all about cash flow and earnings per share in the end. And a typical short selling thesis is, okay, well, a company will be compared to its competitors, and a short seller might say, hey, these margins are too high, they're higher than the competitors, it's a fraud or something's wrong. Well, that may be just the wrong basis for going into a short. You need to look into the company because they just may do things better. and be a better competitor. And so that's not good enough. So, looking deep into what drives margins for that company, and more importantly, the cycle of margins over time. Sometimes companies show patterns over time. If you look at their filings over 10, 15, 20 years, if it's been around that long, you can see cycles sometimes. And so you either have stocks, the margins just in a very tight, flat range. You have some that are going up, and you have some that go down. You have some that are volatile. Those are the ones I'm looking for. Those ones that have very volatile kind of margin streams. And you see that a lot in tech companies and IPOs going public. A lot of tech IPOs will go public, during a peak margin cycle, and where the margins are going to start thinning out because they need to replace it with new product. So a key I looked like, okay, where's a company in the margin cycle? Where is it in its product development cycle? Is it going to be able to replace these legacy products coming out? And so I've been successful at times finding those little patterns and then shorting into it. But again, that's a situation where you may be wrong in your timing by a quarter or two. But it works well with IPOs in the tech sector, really. I can send you some case studies after we're done here. I'll give you my email on all these red flags, actually, which I can show you a case-by-case point how all this stuff worked. On the other side, looking at low margins, maybe a red flag if you want to buy a stock. I call it a red flag, not necessarily a risk, but unattractive. And I'm not a big on quoting investors all the time. I'm a big Peter Lynch fan, big Buffett fan. But Buffett said something. He said it's not actually the level of margins, it's where they're going to go. So if I'm looking at a company with really shitty margins, really crappy margins, but I look at it, look at its competitors, and I say, okay, well, it's got a lot of possible improvement to go in margins, and I look at the history, it used to be higher, and then you do your fundamental analysis, you find, wow, these margins are going to improve, even though they're shitty margins, they're going to get better, which could drive earnings. And what you love about that is if you can find a company at the worst point in its margin cycle and pinpoint it, and then buy that stock, you got like 9 innings to go through of margin improvement over time. You can get some crazy multi-baggers, and it's just amazing. And I learned that along the way, because when I first started investing, I just wanted these great margin companies, which was fine, but everyone knew they existed also, so the valuations were not as undervalued as they wanted. Over time, I started taking a little leap of faith and starting investing in some shitty margin companies, but then digging deep into the company and saying what's going to happen here, and are things going to turn around? And that's where some of my best multi-baggers have come from. Shitty companies that look crappy, but have weak margins, but are going to improve over time. That's moving on to my next thing here is, this is like 101. Any level, any investor can utilize this. I call it inconsistency red flags. It's the easiest way to find opportunity without even being, without being a great, an expert investor. And we know with the amount of information we have available to us these days, it's awesome. So you can just compare statements by management teams across conference call transcripts, press releases, SEC filings, and presentations. And you often find inconsistencies, not only from a bear or a bull side. So the first thing I do, during earnings season, I'm all over it. And used to not be able to get earnings call transcripts years ago. Now Seeking Alpha makes it available; it's free. So you're on par with other investors, institutions. So, and it happens a lot in the small cap, micro cap markets where you'll have a company that'll come out, have a mundane press release, and then and the conference call has just new information. So I'm looking for either stocks that got crushed on earnings day, then I go to the conference call. Hopefully, maybe the best is to go live on the call so you can catch it and hear if there's if there's a reason they give in the conference call that they're not giving in the press release, and then you go and hopefully buy the stock that moves up. And with Twitter, you can tweet about it too, so you can catalyze it somewhat. On the other side, sometimes stocks are going up, on the earnings release, like really outsized returns. And I want to go on the conference call and see, well, are there things that management's warning about? Hot like liquidity, they need to raise money. Is a contract running out? What really caused that quarter to be so good? And is there going to be an aberration? And I'm telling you, it's the easiest way to make money in this market. It's one of the information arbitrage things I talk about, finding public information in hidden corners that investors either don't have the time to look or they just don't know where to look. And it's like really easy stuff if you can just find these inconsistencies. It's information, and then you're just trying to, the market eventually is going to find that information. You just need to find it quicker, and that information is, can be found easiest in the micro cap and small cap markets. Now, and then I'm going to go to this SEC disclosure. So SEC, this is a little more, it's boring. I love SEC filings because it's a place where people like to ignore it because they're long, they're boring, and it just seems all boilerplate and mundane. But I like to look at, there's red flags like customer concentration. We all know that, legal risk, all these things. But there's a section I love in the SEC filings called subsequent events. And subsequent events portion of the SEC filing talks about things that have happened between like the last 10Q and the next 10Q, like in the first and second quarter, or even in the 10K, there might be a section like that. And it's either going to expand on potentially a press release that the company may have issued during that period, or an event, or potentially bring up a new event that they haven't even talked about in a press release yet. And that's golden, right? So a quick example of that would be, there was, I won't mention the symbol at this point, but it was a stock that it's been running real hard, and because they sold some assets, it was a mundane industry. They sold their shitty assets. They talked about investing in growth going forward because they raised some cash from the selling of the assets. Then they announced an acquisition, but I like acquisition type of stories, because you can get a really nice improvement in earnings and sales pretty quickly like that if it's the right acquisition. But they didn't give much detail in the press release regarding the acquisition. So then not too long, a couple weeks later, their 10Q came out, and I went right to the subsequent events section in the filing, and they talked about the acquisition. So in the press release was wonderful. Oh, we're entering the fleet management telematics industry, which is a sexy industry right now. Software, hardware to monitor drivers and help truckers, fleets become more efficient. It's a big buzzword now, but so you go to the subsequent events section, it talked about it. Development stage company with zero revenue. And then you find out, okay, well, wow, they're issuing 30 million shares, in a preferred convertible kind of note, which is going to be massive dilution because I think the company has like 7 million shares outstanding. And the stock still has not reacted to this news at all. And then I find out, wait a second, the company they acquired it from, the acquired company, is a CEO of another public company who's got some fraud ties. And then I find out the guy they're running the company they're kind of related. I think they're actually bloodline related. So wow, I went into this situation with hoping I would have a bullish kind of idea, a bullish kind of thesis, and it turned into be a situation where I'm bearish now. And if you're bullish and if you're not looking in these areas, you're going to be side slapped one day when that news comes out and you didn't look in those areas, look in that section of the filing. So that's one example of that, and I have more I can talk about in my emails to you guys later, and girls. And gap and non-gap. Gap and non-gap, so this is the last thing I'll talk about, and I'll cut it. So companies have to file, with the SEC using generally accepted accounting principles. And there's a lot of debate if we're going to gap and non-gap numbers. So non-gap is a way that companies can adjust the gap numbers to make themselves look, in their opinion, more representative of what they should look like. So there's a lot of degree of manipulation you can have. So the short sellers will say, hey, we'll look at non-gap numbers and criticize non-gap numbers, saying, okay, the earnings look higher than the gap numbers, and there's maybe a fraud there. But the key is this. The key isn't to make that assumption, because you can manipulate gap numbers to look how you want to be. The gap numbers can be too aggressive or too conservative. Non-gap numbers can be too aggressive and too conservative. It just depends on the management team. So the first step to take there is to really go in there, what company you're looking at, and calculate your own number, what you think the real number should be in terms of what this company earnings power. Then you compare it to the gap and the non-gap numbers they're providing, and then you make adjustments from there. And you can find, the ideal situation in short, obviously, is to find stocks that are being overly aggressive in their numbers, and you look for a short thesis. And the other side, and the bullish side, is you look for companies maybe that are being under their numbers that they provided are actually should be better. And then you have some interesting things there, the conservative management teams. So that's the bullish side. So that's it. If you ever, my email is Maj, M-A-J, @geoinvesting.com. I can send you case studies that we've written about on each one of these scenarios. I can send you a bunch of articles on these topics and I've written over time that'll help bring it more into focus maybe, and I'm always available to chat if you want to learn more about it. So thank you.